Hi, I'm Natasha Vidge-Greiner. I'm the director of the SEC's Division of Investment Management. Thank you to everyone for joining us today in person and then also online for the 2025 Conference on Emerging Trends in Asset Management. Before I begin, let me start with the standard disclaimer. My remarks today reflect my views as the director of Division of Investment Management and do not necessarily reflect the views of the Commission, the Commissioners, or other members of the staff. This is our third annual Conference on Emerging Trends in Asset Management. These conferences bring together a variety of asset management industry participants, regulators, commentators, and academics for what I presume will be a lively discussion on emerging trends in the industry. I'm excited to engage on some of the most important and thought-provoking topics facing the asset management industry today. We'll discuss how current events and developments over time are shaping the industry, and we will share insights on opportunities and challenges that we are facing together. This year marks a notable time in the asset management industry's history as we commemorate 85 years of the Investment Company Act and the Investment Advisors Act. To say the least, we've come a long way since 1940 is an understatement. In 1940, the asset management industry held only about $2 billion in assets, which included $1 billion held by registered funds. Now, 85 years later, the Commission oversees registered funds that hold more than $39 trillion in assets and registered investment advisors with approximately $145 trillion in regulatory assets under management. As I'll touch on in a bit, this increase in fund assets and advisors' assets under management tells only part of the story of our significant industry expansion. The number of investment products and types of strategies being offered have also proliferated over the decades, showcasing endless innovation. The opportunities for American families to invest in the nation's securities markets are broader and more varied than ever. The core protections of the Investment Company Act have been crucial in facilitating the growth of the asset management industry and the introduction of innovative new products over the past decades. Congress recognized that while fund disclosures are vitally important, there was a need for investor protections beyond disclosure due to investment companies' unique characteristics and their importance in the national economy. In particular, the Investment Company Act provides investors with specific protections against conflicts of interest, misappropriation of funds, and overreaching with respect to fees and expenses. The Investment Company Act also balances these protections with regulatory authority for the Commission to grant exemptions from these requirements where necessary and appropriate in the public interest and consistent with the protection of investors. Indeed, some describe the exemptive authority as the most important part of the Investment Company Act. Without the Commission's judicious use of its exemptive authority, the Investment Company Act would have the danger of becoming stale and stifling innovation. The Advisors Act, for its part, is generally principle-based, especially in comparison to the numerous detailed and substantive requirements imposed by the Investment Company Act. The Advisors Act protects investors primarily in its anti-fraud provisions, the fiduciary duty that an investment advisor owes its clients. This principle-based approach provides appropriate flexibility in light of the wide range of services that investment advisors offer their clients and the large variety of advisory clients. Both acts, while flexible, strike an important balance, providing protection to investors and stability to the financial markets. The Investment Company Act and the Investment Advisors Act have been truly successful in producing a framework that is protective, but also enables change and innovation. There's also another legacy of success over the last 85 years. The Commission and the staff's prioritization of engagement with the asset management industry and the key stakeholders. We value and appreciate this engagement. This back and forth is crucial as we consider our regulatory approach, including when and how to permit innovation in the interests of investors. We should not work in a regulatory vacuum. Engagement is critical to our own success. The Conference on Emerging Trends in Asset Management carries on this tradition of engagement. Today's conference will feature lively panel discussions on several topics: digital assets and tokenization, product proliferation and innovation in registered funds, and retail access to the private markets. Additionally, for our first panel, we are fortunate enough to be joined by several former directors of the Division of Investment Management who will reflect on 85 years of the Investment Company Act, the Investment Advisors Act, and their time as director. Their perspective is invaluable as we think about the next 85 years. The past is more than just a record of events. It is a predictive tool that can guide us in anticipating potential challenges and help shape the regulatory landscape in a constantly evolving market. In understanding the past, we equip ourselves to better navigate the future. The topics covered by our panels today reflect developments, opportunities, and challenges facing the asset management industry. I look forward to hearing the broad views on these topics today and the months and years ahead. In discussing trends over time in the asset management industry, the evolution of the exchange-traded funds is a perfect example how we can best balance investor protection while still promoting innovation. The evolution of the ETF industry demonstrates the resilience of the Investment Company Act in the face of novel products and strategies. The Commission approved an exemptive order for the first ETF in 1992. Over the next 25 years, the staff, pursuant to delegated authority, granted over 300 exemptive orders to ETFs. In 2019, the Commission adopted a rule codifying the exemptive relief for exchange-traded funds to operate without obtaining an order from the Commission. ETFs now account for approximately 25% of the investment company's assets. And since the ETF rule was adopted in 2019, the amount of ETF assets has nearly doubled. Years of extensive engagement with the industry informed and ultimately culminated in the ETF rule. The rule reflected conditions that evolved over time as the Commission considered new ideas for market participants as part of the exemptive application process. The ETF rule was designed to establish a consistent, transparent, and efficient regulatory framework and facilitated greater ETF competition and innovation. But now that the rule has provided and made clear standards, the requirements for ETF registers and operate, we turn our focus on ETFs that fall outside of the rule's ambit. We continue to receive requests for exemptive relief from active ETFs who seek to operate as non-transparent ETFs under a proxy disclosure or blind trust based on relief that was issued to certain non-transparent ETF sponsors in late 2019. And we continue to consider other innovations, such as funds offering both mutual fund and ETF share classes. And as we grapple with these and other next-generation ETF products, the tools and principles that have traditionally supported the division's work will continue to guide us. Innovation in fund strategies has continued to thrive over the years. The range of fund strategies available has become notably more diverse over the past 25 years. For example, the number of equity funds that are sector funds increased from 2000 to 2024. And funds with thematic strategies have also become very popular. Morningstar data currently categorizes over 300 domestic funds as thematic funds, with over 130 separate sub-themes ranging from 3D printing to wellness to space exploration. And beyond vanilla equity and fixed income, funds investing alternative asset classes and using derivatives and other financial instruments to execute their strategies have attracted substantial amounts of investment. When we consider products that provide exposure to new asset classes, the core protections of the investment company and its rules provided are top of mind. These protections include, for example, requirements related to valuation and liquidity, and at the same time, we appreciate that enhancing retail exposure to novel asset classes could diversify investors' investment allocations and could provide investment opportunities that better match some investors' time horizons and level of risk tolerance. Fund investments in crypto assets have been growing and are varied. Based on our review of public import data from December 2022 to December 2024, total net assets in ETFs holding cash and derivative crypto assets have increased from $2.1 billion to $12.7 billion. Moreover, the staff has observed that funds use a variety of strategies to obtain exposure to crypto assets, in many cases through derivative investments, and that they pursue a variety of objectives with respect to crypto assets. Such objectives include funds that seek to track the return of one or more crypto assets, funds to seek to include exposure to crypto assets as part of the broader overall objective, and funds that seek to provide structured returns, including leverage and inverse exposure based on one or more crypto asset. As the crypto asset industry evolves, the staff expects that funds will continue to seek exposure to crypto assets and pursue new objectives, including crypto assets in innovative ways. With such innovation comes opportunities, but also challenges. We've seen a rise in novel and complex filings over the past year, and we are eager to work with applicants to find a path forward and while continuing to ensure the fundamental underpinnings of the Investment Company Act and the federal security laws are upheld. To that end, the staff is working very closely with the Commission's Crypto Task Force, which was established earlier this year, and to provide clarity on the application of the federal securities laws to the crypto asset market and to recommend practical policy measures that aim to further and foster innovation and investor protection. Much like investments in crypto assets, investments in private markets are also growing. We've observed a dramatic increase in the rise in amount of exempt offerings over the past decade. And the growth of private markets may not be limited to institutional investors. Retail investors may also seek to gain exposure to private market investments, such as private funds. Registered investment vehicles report $96 billion in holdings of private funds, an increase of $59 billion, or over 150% since December 2019. Private funds like hedge funds, private equity, and private credit funds offer diversified exposure to asset classes across private markets. Although the federal securities laws generally limit investors to these funds to accredited investors or qualified purchasers, these typically include institutional investors and high net worth individuals. Retail investors, for their part, generally can gain access exposure through investments in registered funds, including to a limited extent open-end funds and more appropriately closed-end funds. While open-end funds portfolios are restricted by both liquidity and daily valuation requirements, closed-end funds are not subject to such restrictions. As a result, closed-end funds can offer retail investors greater exposure to less liquid assets, such as private funds assets, while still subject to the protections of the Investment Company Act and management by a registered investment advisor. With this in mind, we're working with registrants on an appropriate path forward with respect to the potential opening channel to retail investors. Our understanding of private markets has increased significantly over the past several years as disclosure practices for both registered and private funds have increased. As a result, I believe it is appropriate to consider under what circumstances private fund investments should be available to investors who are not accredited or qualified purchasers through these registered fund vehicles. That said, robust disclosure is appropriate for funds that are available to retail investors and that invest in complex assets like private funds. Our disclosure staff is working diligently with issuers that want to offer private fund-to-fund products, ensuring that their disclosures are tailored to retail investors. I ask that issuers reach out to the IM staff and have patience with us as we work to move these disclosure issues and products forward. Before I conclude my remarks today, I would like to acknowledge the tireless dedication and unwavering commitment of the division staff. As we celebrate the 85th anniversary and note the significance and the resilience of the Investment Company Act and the Investment Advisors Act, it also is critical to acknowledge the people who work day in, day out at this agency to uphold the fundamental principles of the acts and ensure that they remain evergreen. When I addressed this conference last year, I had only been director for a short period. Since that time, the division has been incredibly busy and very productive. I'm constantly impressed by the professionalism and collegiality of our staff. While administrations may change and topics or priorities of the day may evolve, the staff remains steadfast, bringing their professionalism and expertise to the office, both figuratively and literally, every day to ensure that the core tenets of the Act are maintained. Their diligence and professionalism has been instrumental into the division's success. Today's conference is just only one example of their hard work. I'd also like to thank the panelists for their time, expertise, and willingness to participate in today's conference and to share their varied perspectives. Their input will be, I'm sure, thought-provoking, and I look forward to hearing their observations of and any of the lessons learned from those emerging trends in the asset management industry that they can highlight today. As the investment management industry continues to grow and innovate, one thing remains constant: the importance of the Commission's tripartite mission. As we look ahead and focus on setting guardrails within the asset management industry to continue to be able to innovate, it's important to keep in mind that the importance of the resilience and adaptability of the existing structure and the regulatory protections contained in the Investment Company Act and the Investment Advisors Act. 85 years later, the foundational principles of both acts still hold strong. And now I have the privilege of introducing Commissioner Hester Peirce, who will address the conference in advance of the panels. As many of you know, Commissioner Peirce has had a distinguished career in public service. She served as commissioner for over 7 years, leads the Commission's crypto task force, was senior counsel on the Senate Banking Committee, and near and dear to our hearts was a staff attorney in the Division of Investment Management. And in addition to serving as counselor to the commissioner and now chairman, Paul Atkins. Listing her accomplishments don't do her justice, however. Although undoubtedly impressive, her resume does not convey what's most important. She is a friend not only to me, but to the division and the agency. Please join me in welcoming Commissioner Peirce.
Thank you, Natasha, for that very kind introduction. I am not a poster child today for the thematic wellness ETFs that Director Greiner mentioned, and so that is why I'm not there in person and not even there on video. Welcome to the third annual Conference on Emerging Trends in Asset Management. I'm grateful for those of you who are there in person and particularly for those who are participating as panelists today. Before I begin, I must remind you that my views are my own as a commissioner and not necessarily those of the SEC or my fellow commissioners. Today's 4 panels take us on a tour from the beginning of the 40 Acts up to the most recent developments in asset management and on to the developments likely to come in the near future. These panels are in keeping with the asset management industry, which is an iterative one in which new developments are rooted in the old. I'm looking forward particularly to hearing from our panel of former IM directors who will reminisce on 85 years of the Investment Company and Investment Advisors Acts. Thinking back to my own arrival at the Division of Investment Management as a wide-eyed staff attorney 25 years ago makes me feel anything but young. But happy memories linger from my 4 years in the division, immersing myself in division history with the well-worn green binder Bibles, wrestling through current issues in a rulemaking, or imagining the future of asset management through the eyes of the Red Book. My colleagues, of course, were the highlight of that experience. Paul Roy as division director, Hunter Jones as remarkably patient supervisor, Bob Plays as master rule drafter, Martha Peterson as consummate mentor, and countless others, some of whom only recently left the staff, including Bill Middlebrooks, Becky Markany, Chris Chow, Penelope Saltzman, Jennifer McHugh, Jennifer Salwin, Janet Grossnickel, and Nadia Reutblatt, to name a few. These and other members of the division staff poured themselves into administering the statutory framework within which the asset management industry has flourished. Although I'm not feeling it personally, the first panel's Forever Young title is an apt reminder that the regulatory framework must retain nimbleness and flexibility, even though these characteristics typically wane with age. As the panel embodies, however, the wisdom of the past should guide our exercise of that flexibility. The asset management industry is in the midst of an age of innovation, a topic which will occupy the last 3 panels. Continued product proliferation, increased retail access to private markets, and tokenization will expand the menu of investment options available to investors. Accompanying that expansion should be education, including the innovative use of new technological tools to educate investors and their financial professionals about innovative product offerings. For the sake of portfolio diversification, retail investors need access to a broad range of investment opportunities. The breadth of the public markets where retail investors do most of their investing has suffered as the number of listed companies has declined. Companies wait longer to attempt an IPO, and several large companies dominate the public market indices. The Commission should work on reforming public company regulation to help address this decline, but some assets are not fit for the public markets. Accordingly, retail investors and the financial professionals that serve them also are looking for additional diversification in the private markets. Commission rules and regulations, along with Commission staff positions, have contributed to keeping retail investors out of the private markets. We should consider how to amend the accredited investor definition in the Commission's rules so that more people are eligible to invest in the private markets. In August 2020, the Commission supplemented slightly the existing net income and wealth categories for qualifying natural persons, a change the Commission admitted was marginal. I'd like to see more meaningful expansions, as would many retail investors who resent being cut off from an increasingly large segment of the market. The Commission staff can take other steps at once to allow retail investors greater access to private markets. For example, as Chairman Atkins recently noted, since 2002, Commission staff has taken the position that closed-end funds investing 15% or more of their assets in private funds should impose a minimum initial investment requirement of $25,000 and restrict sales to investors that meet the accredited investor standard. Neither the statute nor Commission rules require such limitations. Removing them would allow retail investors greater access to private investments through a closed-end fund wrapper with the benefit of professional management. I support the Chairman's directive that the staff address this situation, including by ensuring that funds are making adequate disclosure regarding conflicts of interest, illiquidity, and fees for closed-end funds that trade on exchanges. We also should work with fund sponsors that want to experiment with interval funds. Some retail investors also want to add digital assets to their investment portfolios. Until recently, the Commission mostly stymied their efforts to do so through convenient and cost-efficient securities products. Some 40 Act funds afforded investors indirect exposure to crypto assets, but only when pushed by the courts did the Commission greenlight the trading of spot Bitcoin and later spot Ether exchange-traded products under the 1933 Act. The trading and market staff is working diligently through many applications to list a whole range of digital asset ETPs. A standardized approach for such ETPs could ease the burden for the industry and the SEC staff. Asset managers are also are creating new products under the 40 Act. Just as a reminder, a fund that invests primarily in spot crypto assets that are not securities cannot register as an investment company under the 40 Act. Additional guidance could open the door to enhanced investor choice and increased portfolio diversification for investors. The Commission is working, for example, on providing clarity for investment advisors and investment companies. One area in which there's a lack of clarity is how investment advisors and investment companies can hold digital assets in compliance with the current Commission custody requirements. One issue causing significant uncertainty is whether using state-chartered limited purpose trusts as a custodian of crypto assets would be consistent with the custody requirements of the Investment Company Act and Investment Advisors Act, and particularly whether they meet the definition of a bank provided in both acts. More options for crypto asset custody may be coming following the rescission of Staff Accounting Bulletin 121 and clarifying statements made by federal banking regulators, including the OCC. I hope that the staff of the Division of Investment Management can clarify how funds and advisors can treat a state trust as a bank with respect to the custody of crypto assets. More permanent clarity about how to apply the custody provisions to digital assets requires a deeper look at whether the custody requirements should continue to be based solely on qualified custodian status rather than on principles and qualitative criteria that may better ensure the safe custody of crypto assets. The Commission also should address questions as to whether registered investment companies may obtain exposure to crypto assets through investments that do not trade on a U.S. regulated exchange and the tokenization of securities issued by registered investment companies. The third panel deals with product proliferation, a testament to the creativity of the asset management industry and the flexibility of the governing statutes. The growth in and variety of exchange-traded funds is remarkable. The breadth of offerings serves a wide diversity of investor needs and often does so very cost-effectively. Some of these products are complex and not fit for every client portfolio. Some of these products are designed not to be held for more than a day. They are tools for managing risk and volatility, enhancing returns, and limiting loss. If used incorrectly, they can have the opposite effects. The staff of the Commission, which is not a merit regulator, works hard with registrants to get the disclosures right for these products. Given the importance of understanding how these products work, I would like the Commission to consider whether overly conservative regulatory limits on marketing funds serve inadvertently to inhibit educational efforts by fund sponsors for financial professionals and investors. I look forward to seeing asset managers continue to innovate to serve investor needs. I hope that the SEC will commit itself to apply the many years of experience we have accrued with the flexibility necessary to accommodate innovation by incumbents and new entrants to the industry. May the rest of the conference help you to gain wisdom from industry and regulatory veterans while staying forever young. Thank you.
So I'm going to kick it off. I am thrilled to be joined here today with a panel, an esteemed panel of very accomplished and impressive former IM directors. We had dinner last night, and it is proven that once you're an IM director, you're always an IM director, and you're always concerned and thinking about the asset management industry, but also proved that this is collectively a great bunch of people that are passionate about the SEC, but also the people within the division. And I can't wait for you to hear the stories and their perspective that we're going to talk about today. So I thought I'd just very quickly, they have very impressive bios. Please look online for them. But I thought I would just mention just maybe their tenure and introduce them. Alan Mostoff, he was director of IM in August 1972 to January 1975. Joel Goldberg, he was director of IM in January 1981 to May 1983. Barry Barbash, director from September 1993 to October 1998. Buddy Donahue, director from May 2006 to November 2011. Norm Champ, director from July 2012 to January 2015. Dave Grimm, director from May 2015 to September 2017. Dahlia Blass, September 2017 to January 2021. And William Birthistle, director from December 2021 to March 2024. I forgot to highlight the title of our panel, Forever Young, and I thought it was so perfect because we are all young at hearts, as is the Investment Company Act and the Investment Advisors Act at 83, or 85, sorry. So we're going to reflect on 85 years, but more importantly, they're going to reflect on their time as director. One of the things that came up at dinner last night was who was the youngest IM director at the time of their tenure. I think someone posed that question because they thought it might be me. I was not. And so to the extent that I can share, Joel was IM director at the age of 37. So congrats, that's a huge accomplishment. And then Alan was not the director of investment management at the time, but he was the first IM director. And what was your title and what was the division called at the time?
Investment management regulation, a key word, which disappeared.
I guess worry about that, but.
And I guess it's my job to talk about the first 35 years, from 1940 to 1975. When I joined the commission, and it was really interesting because there were people there who had started in 1933. One of the division directors, who's not here now, unfortunately passed away, Sid Mendelson, joined the commission when the commission was in Philadelphia as a messenger and worked his way up. And when I was the director, he was an assistant director. A terrific guy. So I had the pleasure of working with people who knew why the commission was created. They were part of it, part of the inception, and it was really very, very exciting. Now, the division didn't exist. Regulation of mutual funds or investment companies was an afterthought, and it was tucked into the Division of Corporate Regulation. And when I left the special study, went to the General Counsel's office for a few years, Then Chairman Manny Cohen decided that the Division of Corporate Regulation needed some beefing up, and he moved two of us from the General Counsel's office to the division, Jack Dudley, who was an assistant director, and I joined the division as a special counsel. He eventually became an assistant director, then an associate director, and then in 1972, the director. We, meaning the commission, had looked at mutual funds and investment companies as emerging important tools for investors to participate in the growth of the economy. But it was a slow and then eventually a rapid growth. It became a concern for the commission as part of the commission's worrying about the structure of the securities markets and investments when the special study of securities markets was put together and authorized by Congress in the early 60s. And the commission asked the Wharton School to develop a report and on the industry, and they identified what they described as potential conflicts of interest and an absence of arm's length bargaining between the management of the funds and the shareholders. And they urged that the regulators focus on these issues. In the special study, as an afterthought, Chapter 11 worried about the problems with selling practices and contractual plans and reciprocal arrangements for brokerage. We started with that framework and recognized that the 40 Act wasn't adequate, and there was a great deal of effort put into putting together the proposals to amend the Investment Company Act in 1970 to try to deal with advisory fee levels, the economies of scale, the sale of an investment advisor. That was a major issue for the commission, whether an investment advisor could be sold, and whether the sale would create a burden for the clients of the investment advisor, sales loads. The role of directors became a key issue and is today a key issue. I wonder whether the directors are going to be able to understand the new products that you talked about. That's really very important in my mind. So 1970 came along, the statute was amended, and then we spent a lot of time, when I was an associate director, implementing the statute. I also personally spent a lot of time on a foreign investment company operation called the Fund of Funds, operated by a company called Investors Overseas Services. And it was in that context that I had a chance to really take a second look at the role of directors. I was at an annual mutual funds conference in 1971 when a helicopter came into Palm Springs with great fanfare, and the head of the Investors Overseas operation got out of the helicopter and marched in and gave a keynote address to the conference. His name is Bernie Kornfeld. And when he finished, the audience stood up in standing ovation, and they were admirals, congressmen, former retired people, high levels in the government, all applauding. And all I could do was say, when I followed him, and I was the associate director of the division at the time, that, I've been following you for a long time, but this is the most difficult and most challenging time for me, with that standing ovation. But it made me realize that the directors didn't understand what they were doing, and that turned out to be a major swindle. But when we focused on that, and the commission itself, and several of the commissioners were really interested in foreign funds that invested in U.S. securities. The funds invested in mutual funds, not directly in the securities. And the commission spent a lot of time, and I was personally involved in it, working with the Treasury Department to develop a program that and a set of proposals that would have created the mechanism for a foreign organized fund to register under Section 70 of the 40 Act. That ultimately resulted in legislative proposals, which ultimately vanished. And so that never happened. And I don't know whether there are foreign funds that are knocking on the door under Section 7D, but we thought it was a good idea at the time. During my time as director, I had to deal with variable life insurance contracts. We managed to work that out. Reciprocal practices for fund sales and the NASD rules. The proposal to repeal or modify Section 22D regarding the public offering price. We had public hearings on that. The idea was to enable price competition under Section 22D, which we did. We started to take a look at fund advertising relaxation, which Joel finished up with. In the summary prospectus, we dealt with mini accounts, which were mass merchandised, individualized accounts, and tried to develop a framework for that. In 1974, we were presented with money market funds for the first time, and that was amazing. And in 1974, we saw the end of the offshore unregistered fund idea. In the 1975 amendments of the Securities Acts, we saw Section 13F come into play. There was a time when the market would crash, funds were stuck, and no one knew which funds held which securities. So that was the thought process behind 13F. And the 1975 amendments clarified clarified the ability of an investment management company to go public or to sell itself, and that was a major issue that the Commission had wrestled with in the 60s. When I first joined the division after the special study, I was visited by the chairman's administrative assistant to tell me that was the most important project that we would be working on. There was a case that we were dealing with, and we put together a program for the Commission to deal with it, and we took it to the Commission, and the Commission backed away from it. So, that was the end of that. The brochure rule. The brochure rule started out of the special study. I spent a lot of time in the special study in the investment, chapter 3, I guess it was, on investment advisors, investment managers. And it occurred to me that there was no way that a client would know what the investment management company was all about. There was no brochure or anything like that. So I made the suggestion. There was a suggestion box at the Commission. I got a $100 award for that. And that was the start of the brochure rule. 1975 saw the explosive growth of money market funds, which we had to deal with, and the registration of the first time of index funds. We also had the interesting experience where a former chairman, Hema Budge, came to the Commission and met with the commissioners and the senior management of our division and made a plea for something to do for the commission to respond to the fact that I guess his company was invested in Diversified Services, I think. He was then the chairman of a board of funds, and they were having trouble with their sales, and so that we should do something to facilitate the marketing of mutual funds, make it easier. And that was the start of modification for 12B1 and the creation of 12B1. And the most significant thing, well, maybe, at least in my mind, a very significant thing that happened in 1975, which the commission facilitated, was the internalization of Vanguard. That was a terrific thing. And I personally was disappointed that that was a one-off that no one in the industry followed. But the Vanguard operation has been very successful, as we all know. So that was my story. That's the first 35 years of administration of the 1940 Act.
Thanks so much, Alan. Joel, would you like to talk a little bit about your tenure and your look back?
Yeah, sure. I know that we're probably going to run short of time, so I think I will confine it to one particular thing. And it's not something we did, but something we helped prevent happen, which was that there was a strong attempt at the federal and especially state level to make money funds illegal. And that's hard to imagine today. But as Alan indicated, the money funds were invented in the mid-1970s. By the early 80s, interest rates had skyrocketed. Short-term interest rates had skyrocketed. They were 16%. And the banks were still restricted by Regulation Q, doesn't exist anymore, on the payment of interest on savings accounts, 5.25%. So you can imagine not many people wanted to get 5.25% if they could get 16%. The money funds were just gathering assets like crazy. The banks had a choice. They could have said, we're going to lobby to try to get Regulation Q eliminated, which is what finally happened. But instead, they chose to try to get the money funds outlawed because they kind of liked the idea of paying their customers 5.25% when prevailing rates were 16%. The attempts at the federal level were not very successful, but several states came close to making laws that would effectively outlaw the money funds. And as a lot of you know, if a type of fund is illegal in 2 or 3 or 4 states, it's effectively illegal everywhere because you can't really control where the shares go. The argument the banks made was that money funds aren't insured. They're not safe because unlike bank deposits, they're not insured. And the division at the time was not accustomed to the role of trying to help the industry. That wasn't our job. It wasn't how we saw it. But the money funds and the Investment Company Institute came to us and said, can't you help explain that insuring money funds makes no sense at all because they're not debt instruments, they're equity instruments. They're treated as debt, but they're actually equity. And what we helped to do, I think, with some success, was to explain that concept to the state legislatures that were about to pass very damaging legislation. We explained to the legislatures that if a bank becomes insolvent, if their debts exceed their assets, the last people out of the bank loses everything, right? In the absence of insurance, the bank goes bankrupt. We explained that in the case of a money fund, that isn't true. If the money fund goes down 1% in value, everyone's share is worth 99 cents rather than a dollar. But the last one out still gets 99%. I think that our work in explaining the realities of the money fund industry was probably the thing I am proudest of.
Thank you, Joel. Barry?
When I look back on my 5 years as division director, I think in terms of themes, there were certainly events that took place. There was the Bonn Massacre of 1994. There was in 1997, there was an Asian market turmoil with the bottoming out. So those were big events. But those events didn't have the same effect that some of the later events had for other tenure, where you saw major changes in the legislation. During my tenure, it was that the commission would respond to them. We would take action. Maybe there would be enforcement cases. But we, at that point in time, weren't looking to have a legislative response to every event, which I think is a little bit different. It was a different time. In terms of the themes that I believe were important during my tenure, I was appointed by Chairman Arthur Levitt, and he had certain themes that he really wanted to try to advance, most notably disclosure in the mutual fund area. He thought that disclosure was unclear, needed to be better. We should try to work to have plain English in prospectuses, and a lot of initiatives during my tenure was that. It's reflected in when I left the commission, the chairman's office put together a collage for me to represent what happened over the 5 years, and it's basically all disclosure. And I think if you looked at the amount of press and the articles back during my 5 years, a lot of ink was spilled on prospectus disclosure. I tend to look back at some other themes that were more important in the long run, but I think if you look back publicly, that would be one important one. The other compelling theme that came out, and something I think is near and dear to Alan's heart, was Chairman Levitt started to be much more public about governance and the role of independent directors of mutual funds. He knew something about the board process from his time in New York, and there were a lot of articles in the press in the early 90s about mutual fund directors not doing enough, independent directors not being tough enough. They weren't watchdogs, they were lapdogs. And he tried to respond to that, I think, by taking a very public position and trying to articulate much more about what directors should be doing. And that started the industry down the road of focusing much more time and attention on independent directors. Alan had the initiative with others of the Mutual Fund Directors Forum. The ICI went down the road as well. And I think that you can look at the roots from 1990s on that. In terms of what I think are the more compelling longer-term initiative, longer-term themes that came out of my 5 years, I focus on investment advisors. There was much more of a focus during those 5 years on investment advisors, the Investment Advisors Act, the notion of investment advisors as fiduciaries. We started to see much more focus on that. We started to see much more of a focus on the examination of registered investment advisors. The number of investment advisors shot up at the end of the 1980s into the beginning of the 1990s, and the question was, well, how is the commission going to deal with that? And we considered a number of different initiatives. Should there be a separate entity that just did examinations that was independent of the industry? And ultimately, what happened in 1996 was there effectively was a split of the jurisdiction between states and the SEC in trying to have it such that the SEC would oversee a manageable number of investment advisors. But I think that was an important theme that came out. It was the issue also related of SEC resources. Did the SEC have enough resources to cover investment advisors? That was a huge theme back then, a lot of legislative testimony on that. And then I think we saw what I believe is the most important, single most important structural and philosophical change in the investment management program at the SEC in the IM area, and that was the formation of OC, taking the exam staff out of the divisions. Up until that point in time, the exam staff had been in the asset management area coming out of the investment management division. The same was in the Division of Market Regulation, as it was known then. And the initiative during my tenure was to take the examiners and put them in their own unit, and that became OC, the office that focused on examinations. I think the trend started with that formation. You started to see exam staff members as almost beginning to be providers of interpretations. Up until that point, all interpretations really came out of the Division of Investment Management. With the formation of OC, you started to see a little bit of movement towards the examiners having views. You saw examiners start to focus more on enforcement type actions, worrying about enforcement. Up until that point, historically, the examination function at the SEC was designed to help the industry, advise the industry on what to do, how to deal with regulation. I think in the 1990s, you started to see a more contentious kind of relationship. And I make no call on whether that's good, bad, or indifferent, but I think you started to see that. Another compelling theme long-term was what I would call the implementation of a number of proposals that came out of the so-called Red Book study, the study that the Commission had put out entitled Half Century of Investment Company Regulation, that came out in the early 1990s under Mary Ann Smythe, the division director. And there were a number of initiatives that have had crucial importance to the industry over time. I don't think we ever thought they would, but they are. The one that comes to mind is the Investment Company Act Section 3C7, which is essentially the change of the exemption that investment companies could rely on so as not to be subject to the Investment Company Act. There was an exemption, and still is, for private investment companies with 100 or fewer investors, but all of a sudden we had 3C7, which was an exemption that said that if you had folks who had wealth, folks who have knowledge, people who could take care of themselves, you didn't need to have the Investment Company Act. So you had 3C7, that particular exemption. And I would say that that's been the great facilitator of private funds, of the hedge fund business, the private equity fund business, and that all traces back to that particular initiative, which came out of the Red Book. And I don't think the Red Book authors, I was not the supervising division director, I was one after, but I don't think the folks who wrote that book would have thought that 3C7 would ever have the effect that it did, but it did when tied up with the market. You also saw coming out of that the notion of an interval fund. Also, in connection with that, it didn't exactly come out of the Red Book study, but it was talked about as part of the Red Book initiatives. The SEC had put out a concept release and it asked for ideas with the notion that it was going to produce a study. And a number of investment banking firms in New York, and there may have been others located otherwise, came up with the rough notions that became ETFs. And then, as noted, ETFs, as you noted, Natasha, that it came up in the form of exemptions, but that idea came out of that particular time. Another theme that came out during my time, which I think was a little bit different, was turning up the enforcement heat in the investment management area. The industry for a long time would say we never had problems. The Investment Company Act area was not problematic. The Investment Company Act administration was doing a great job. I remember every year I'd go to a conference and it would be, we haven't had a problem for 20 years, 22 years, 25 years. The problem that was always the reference point was what Alan mentioned, Bernie Kornfeld. But we started to see during the 1990s, I think, a recognition by the commission that investment companies and the amount of assets under management were so significant that it was important to get involved in the enforcement area and go through and look at events. And then in response to market events, you had the SEC take a look real hard in the enforcement area. I remember being criticized at a conference once about being a division director who was too interested in enforcement matters. I also made a comment once at a meeting that, yes, when asked the question, would the SEC ever bring an enforcement case against independent directors of mutual funds, I said, yes, of course. I did not win friends coming out of that conference. But I think, though, these are some of the themes, and that's really how I remember back to my tenure.
That's really great, Barry. I feel like you're not alone. When I took on this role, the one top line question was, she's been in enforcement for 8 or 9 years. What does that mean? So I think that perspective on enforcement and regulatory work and being a policy division head is still out there. So,
you know, I don't want to debate, but I would call into question one thing you said. It started in the 1990s, and I think it's played out. I would really question the premise that the Investment Advisors Act is principle-based. It's a statute that doesn't have that much legislative authority, so you need to really strain if you're the commission. But I would tell you, just as an example, I've done adjunct teaching of the Investment Company Act, the Investment Advisors Act, for close to 20 years. When I started, there was about this much material on the Investment Advisors Act. When I teach that now, there's this much material, and I think they're not all principles.
I definitely think it's evolved over time. Obviously, different chairmen and different time periods have been more principle-based, and then others have been more prescriptive. But I hear your point.
If I can just quickly add one thought on that. If you read the legislative history of the 1940 acts, Investment Company Act and Investment Advisors Act, the Investment Advisors Act was almost an afterthought. It was a census. Congress said, we don't really know how many investment advisors there are. We don't know what they do. So before we pass a lot of requirements, let's tell them all to register so we know who they are.
Yeah.
When I started as the division director, I was asked to do a seminar for the division regarding the statutes that we oversaw. And I remember saying to the division that I can talk about the principles of the Advisors Act standing on one foot. It's 3 Fs and a D. Fees, fiduciary duty, fraud, and disclosure. That's it. That's all it was. I think now you need an iron person to be able to stand on one leg long enough to talk about the Advisors Act.
I appreciate that. So I think we're up to Buddy, and I'm just cognizant of time, and I don't want to take away any of your time, but want to make sure we get past at least the first question.
So I have to make up for what my predecessors did?
As you always did.
Give us a quick and dirty, Buddy.
I'm used to it, so it's. I think, I look back at the time where I was division director, and by the way, it was actually, I think of all the great opportunities I've had in my career, it actually was my favorite job. But it doesn't mean that there weren't challenges. And, I joined in 2006. Everything was going pretty well in 2006, until it wasn't. First thing that I recall that I had to face up to was, the Financial Planning Association suing the SEC over an advisor rule. That started the whole, what I used to refer to as the IABD issue, whether broker-dealers should have fiduciary duties and, the nature and things. And, the first thing we did was actually, commission RAND to do a RAND study. Came out and said, hey, everybody's confused. Then Dodd-Frank decided to jump in and then, did Section 913, so required the staff at the SEC to come out with a report about that. And, it took up a lot of time, and a solution to it wasn't that simple. I thought it was much more than just what the standard of care was going to be. They had quite different roles that they were performing and stuff. And so, Dahlia, I want to thank you for finally fixing that with Reg BI. So that was the first thing I wound up having to face. And then, and I'll just give a little bit of background, the financial crisis, in a period of about 18 months from 2007 to 2009, the Dow, the S&P 500, and NASDAQ each lost over 50% of their value. It was estimated that U.S. households lost about $16 trillion in net worth. And the markets weren't functioning all that well, right? And so from that, came a lot of the things that we had to address. And money funds, come to mind as, one of the big items that we had to address. The beginning of issues in money funds actually started in the summer of 2007 with some structured investment vehicles, commercial paper that was issued by them. And they became somewhat problematic because some of those structured investment vehicles had mortgage-backed securities in them backing And so what you had was a widening of spreads and at the same time a decline in liquidity for those. And so many of the sponsors of those money funds actually stepped in and helped eliminate the possibility of money market funds breaking the buck because of the decline in value that was occasioned by that. And so that was really the first, but it would kind of sidestep that and avoided that. And you then moved to 2008, and we had Bear Stearns, difficulty in March of 2008, and then in September of 2008, you had Lehman Brothers bankruptcy. And there, in the Lehman bankruptcy, there were about 10 or so mutual funds that owned commercial paper that was issued by Lehman Brothers. And so that was going to be a problem. Lehman Brothers was in bankruptcy in terms of whether or not they were going to be able to maintain a stable net asset value of $1. And all but one of the sponsors actually was able to step in and eliminate the difficulty, really, of Lehman Brothers. And there was a rule that permitted the sponsors really to do that without the necessity of coming to the commission. The rule that, when you had a defaulting paper that could be purchased out The one exception really in September of 2008 was the reserve fund. Reserve fund had massive redemptions occurring in a very short period of time. They were really an institutional money market fund more than a retail money market fund. And I think industry itself had $300 or $400 billion worth of redemptions that occurred in a very short period of time. And so the mutual funds were really under a lot of pressure. And money market funds, most people say, well, they're very liquid. Actually, money market funds are basically buy and hold strategies. That there isn't a lot of activity in many of those instruments afterwards. So what happened during that period of time was that many of the investors in money market funds and others were worried about the holdings of the variety of money market funds. And the concern in the financial markets and among many of the regulators was, my God, what happens if there is a huge run on those funds? And also what is happening with regard to the ability of commercial enterprises to be able to issue commercial paper and have that happen. So you had a range of things that were occurring. The division wound up receiving and granting just under 20 no-action letters that affected about 100 money market funds that provided a variety of tools that could be used by sponsors to money market funds to support their money market funds. And Dahlia, thank you for being the intake for that.
I think it was over 100, buddy.
100 funds, yeah.
100 no action letters.
Hey, what do I know? I was just the division director. So that was a very, very interesting time. But also from that, there were a variety of responses that came out. And so you had the mutual fund Treasury Department put together a money market fund guarantee program. And a few of us actually went to Treasury and over a weekend put that together. And just under 80% of the money market funds joined that and paid a few $1 billion in premiums to Treasury. So it was really interesting time. You came into work not knowing really what else was going to wind up happening. And kudos really, I think, to staff at the division, the SEC, but also to the industry stepped up and said, listen, we have a real interest in needing to resolve these issues and deal with them effectively. So eventually in 2010, we amended 2A7 to improve many aspects of that, but also didn't really have the answer to how to deal effectively with.
Can I chip in, buddy, with
Well, I know I can't stop you, so sure.
with a very quick anecdote? I was in private practice when the whole crisis with the reserve fund happened, and I remember talking to Buddy on the phone, and he said he had heard from the Chinese embassy. They had a huge position in reserve fund, and they were upset because they couldn't get the money out. And I said, well, tell them to get in line. Everyone's upset, And he said, yes, but they're the only shareholder who has nuclear weapons. And I thought that was a very good line.
And by the way, there was no way that there was ever going to be any special treatment to any particular investor over others. But there were a lot of interesting things that occurred during that particular area. So I'll put money market funds aside. Also in February of 2008, auction rate preferred shares, which were a form of leverage that was employed by closed-end funds, the auction started failing. And so you wound up with what were referred to as ARPs, all of a sudden going for what I would think of, and I'll use the term incorrectly, but a duration of 7 days or 14 days to being effectively an infinite duration, because there was no liquidity available with regard to those. And that was something that wound up plaguing really closed-end funds, but also the broker-dealers who put people into the auction rate preferred for a period of time. So as you're thinking about dual classes and whatever, go back and take a look at that, because it's really an interesting exercise. Directors were in a terrible position for closed-end funds that had certain ARPs, where they weren't able really to come up with a necessary solution to them. There were a number of bond funds, short-term bond funds, that encountered difficulties, particularly where they had purchased mortgage-backed securities and decided to adjust really some of the exposures by using derivatives. It worked until it didn't work. And so we had a number of short-term bond funds that had, I would say, performance that one would not have expected. 2008 target date funds ran into some difficulties. And to give you a sense of that, a 2010 target date funds on average lost 25% of their value, and there was one that lost as high as 41% of its value in that short period of time. And that, I don't think, was the expected outcome for many, including legislators. And you can imagine that for a number of these, I wound up having to testify before Congress on how these things worked and whatever. In 2010, I had the flash crash. And that was another example, I would say, of where things work until they don't. And that was interesting to kind of work your way through. The Dow fell 9% in just minutes. Recovered quickly, but it adversely impacted many of the ETFs. And there were market rules that impeded the ability of arbitrators to be able to come in and effectively put on hedges, because they were worried if they basically were using two markets to do some arbitrage, that one leg might be disallowed under the clearly erroneous trade rules. And so that was I think a wake-up that sometimes when you solve one problem with doing some rule changes, and of course this was trading in markets, not IM, it can have consequences down the road that you had not anticipated. And it's hard for me to forget I had Madoff, right? So in December of 2008, the Madoff scandal occurred, and we had the commission really wound up with aftermath of Madoff and how to deal effectively with that. And as one can imagine, I, on a number of these things, among other things, I had to go testify before Congress on that. So, I can go back and focus on the fact that crazy times, whatever. Well, I go back and focus on it and say, my God, how great the people were that I worked with at the SEC, and not just in IM, but just throughout, where the desire was to come up with, the answers. What can we do as a regulator to facilitate the resolution of these issues? And then what should we learn from these issues that we wound up facing, so that hopefully we don't wind up running into them again? And when I think back to, what I would say, if somebody said, well, what were the good things you did as opposed to dealing with the bad things that happened? I followed on really with what Barry had started in terms of simplification of prospectuses, and wound up doing the summary prospectus. I give a lot of credit to that, to Paul Roy and all of my predecessors, because it was basically done when I showed up. Mm-hmm. And so, I get credit for it, but I give credit to all the folks who did all the hard work in order to put that all together before I even got there. There'll probably be a shortened summary prospectus at some point, because this is a never-ending challenge, I think, for everybody. 2010 amended 2A7, tried to deal with many of the issues that we've wound up focusing on during a financial crisis. And, Norm, you wound up having to work on that in your tenure and kind of got some other changes over that. And in 2010, Dodd-Frank was a huge law that was being passed, and we had some folks that worked with with Congress in terms of how to fashion that. And one of the big issues was how to deal with investment advisors and how to deal with private funds. And I think we had some good impact in that area. But once again, that was staff going and really just helping people understand approaches that could be taken and maybe why some of the choices, were less optimal than others. I could go on, but in trying not to use up all my time, I'll pass it on to Norm.
Excellent. Thanks, buddy. Great to see everyone. Really, as always, I'm sitting here listening, as rapidly as everyone else to what's gone before, and obviously the kind of the debt that we all have to everyone who's led the division, whether they're here or not. So great to hear about that. I feel like the biggest single thing that we tried to work on in my time was really the deep kind of understanding that what we're all doing, while we're hearing a lot of citations to rules and we're hearing about a lot of reforms and so forth, if you cut through all of that, the business that we're in when you're in the division is helping Americans save for critical life goals, right? So, the American public is in saving and investing for things like buying a house and funding their children's education and funding their retirement. And I look around the room here and I see, so many talented and dedicated members of the staff of the division who really have worked tirelessly to improve the disclosure that those investors are seeing and making sure that these products that are regulated by the commission are, as was mentioned earlier, not being evaluated on a merit basis, but having the right disclosure and making sure that investors know, what they're getting. And so I just kudos to everyone here from the staff who is still here and working on that. In addition to those goals that people are saving for, the proliferation of IRAs, 401ks, other ways that people are getting exposure to our markets also gives them a stake in the U.S. economy and the U.S. future. We're all very lucky that we have tax-favored accounts like 401ks, IRAs, 529s that enable us to access those markets and also do so in a tax-efficient way. If you look at the big beautiful bill, it has an Invest America account under which every child born in America would get one of these tax-favored accounts and $1,000 in that account, which would help us with our declining birth rate, perhaps, and then secondly, also give those people coming into the country, or coming into the population, that stake in our markets. And so if you think about those accounts and the kinds of things that people are saving for, easily the biggest thing that happened around my tenure, and unfortunately the most difficult, was the passing of Dodd-Frank, which happened while I was in exam. But if you look at Dodd-Frank and you look at 2010, in 2010 we were halfway through the devastation of our public capital markets that has continued for the 15 years since then. So we now have half the public companies that we had in the 1990s, right? So 2010 was pretty much the halfway mark of that 30-year straight line decline of our public company population. Around 8,000 companies in the 90s, around 4,000 now. That decline in our public companies, which Commissioner Pierce referenced, is severely limiting the investor choice in all of these accounts that people now have and the stake in the market that they now have. Yes, as was mentioned both by Natasha and Commissioner Pierce, there are steps being taken to increase access to private investments, and no surprise, as a private funds lawyer, I'm all for that, but I think we all understand that there are probably limits to that, and that really, I would single out that we've got to find a way to reverse the decline in public companies so that all these people are using all of these great accounts that everyone here is putting in so much effort to regulate. We've got to get investor choice back for those investors. And if you think about some of the stats, right, are shocking. I'm sure people know the Wilshire 5000 index is supposed to be and was created as the index of all of the investable stocks in America, so stocks that had enough liquidity to be invested in. Unfortunately, the Wilshire 5000 currently stands at 3,300 stocks. I assume they haven't changed the name for fear of intellectual property or whatever, but that just gives you a sense of the dramatic limiting of investor choice that we're experiencing and the increased risk that is going along with that, right? So most of us in this room through, I forget what the commission's, what is it, the TSP? Is that the, right? So everyone here through either the TSP, 401ks, IRAs, basically most of us here are exposed to the same 7 stocks, the so-called Magnificent 7, which comprised 30% of the S&P 500 index, right? And the other 493 stocks comprise the rest. So we're all concentrating the same names. They happen to be all in the same industry. And so a lot of the volatility that we're seeing is related to that. So when you look at Dodd-Frank and you think about what Dodd-Frank did, which was start to replace the materiality standard that everyone in this building grew up with these more mandated disclosure requirements. So I shudder to remember these names. I'm sure a lot of people in here will as well, but extractive resources, conflict minerals, obviously under Chairman Gensler, the climate change disclosure. As we move farther and farther away from materiality and mandate these disclosures, we're increasing liability for these companies that have what do they, like if you're not in the mining business, but you have to do disclosure on that or disclosure on climate, you're going to get it wrong, thus exposing all these companies to strike suits, increasing the already expensive nature of being a public company. And so I'm very concerned about the decline of that standard, the materiality standard, which got us this far, and this limit of choice for investors and the increased concentration. I do agree with Commissioner Pierce that we need reform. I would also say we need permanent reform. So you think about SPACs, which briefly bent the curve and stopped the decline of public companies and went this way a little bit. But then there was an interpretation that SPACs might be investment companies, of all things, and that plus some other market dynamics were the end of SPACs, which had decreased the decline. So I would advocate and say that our time at the Commission was dominated by this Dodd-Frank passage. I think the damage from that continues to this day, and I hope Commissioner Pierce is right that there will be some action to try to reform public companies' regulations so that we can get back to having more of them. Couple things I think that are out there could be maybe there have been some statutory provisions, discussed about returning to the materiality standard, which I think would help U.S. investors. I think in the current version of the bill, the PCAOB is perhaps going to be folded back to the Commission. Obviously, a lot of the accounting requirements the PCAOB have been doing have also contributed to this whole trend. So if the Commission is to follow the 10 repeals for one rule, I would advocate trying to see if we can get the public company markets back. They are still great. I'm not sure they're the greatest, and if we don't take action quickly, I'm afraid that the decline in public markets is going to really seriously impact the ability of all of really our clients, the U.S. investors and people who are saving for the future. So I would summarize that Dodd-Frank was easily the most influential and unfortunately difficult thing that happened around my time. Dave?
Hi, everyone. So the first word that I think of with respect to my tenure at the commission is appreciation for having it. As many of you know, I came right out of law school, and then thanks Barry for hiring me into the division, and had incredible opportunities and issues to work on through a lot of these tenures that you've been hearing about. And yeah, I'm just really grateful to a lot of the people on the stage, a lot of people in the audience for the ride. It was amazing. In terms of my actual tenure as a division director, I mean, you've heard some of this, right? Like, for each director, their time is influenced by like what's going on at the time, right? And so for me and Norm and Buddy in particular, right, you had the financial crisis, and even when you got to me, that was still the thing, right? And so what did that mean, particularly on policy? The liquidity, right? Leverage, those were the things in the financial crisis. What is the SEC doing to be responsive to that? So that drove a lot of the policy. And then just to tie it actually back to something that Alan said about 1975 and 13F, right? Like, data about the markets during some of these crises that these folks have been talking about, right? Like, do we have the data here at the commission to know what's going on? So that was a big part of trying to enhance that for the commission to be able to use more effectively when it came time for market crisis. So that's my 3-minute version of my tenure.
I also think you get the golden star for being concise.
I'm going to do the same. So thank you so much, Natasha, for putting this together, and for hosting us, Norm, last night. It was very kind of you. So just two things in my tenure, and it's so nice to see so many folks from IAM around the room. One is we did like some really great rulemakings, regulation best interest, the whole standards of conduct, ETFs, derivatives. I could go down the list. It was so much fun working with the staff, and most of our rulemakings actually were 5-0s. And we're really proud of the effort we put into that. But if there was one defining moment for us during my time, for better or worse, it was COVID. It was the time when we had to deal with the markets dislocating. And I was actually really grateful that I had spent the time with Buddy during the financial crisis, because we did have a rule book that we could, start with at least, and then, add it on as the markets needed. But, it was not so much actually dealing with the market crisis. It was also dealing with the personal part of COVID. Everybody, the entire globe, moved to their homes. All the markets were being run out of living rooms and bedrooms. And as we were dealing with all of that, trying to work, we were also caregivers and educators, because all our kids were sent home, unfortunately, to stay with us, right? I know. For those of us who had school-age kids, right? My son at the time, my youngest, was only in 2nd grade. Can you imagine him using a computer to get educated? So like, the most defining moment for me is how investment management, this division, came together, and we supported each other through something that I hope that we never get to experience again. We did our jobs, we protected the markets, but we also really came out and protected each other and made sure that the entire division came through as a community. So for me, we did great things as a division, and a lot of the stuff that the prior directors mentioned, because every division director's tenure is going to be impacted by the prior, right? It's a continuation. It's not a restart. So all of that were themes we did. But for me, it was, for better or worse, the COVID experience. That was a pretty defining moment. William, on to you.
Thank you, Dahlia. Yeah, the great joy of my time, since it was really not that long ago, is that most of the people in the room here were my colleagues, and Buddy said it earlier, this was also the very best job I've ever had. And a large part of that was getting the chance to work with so many of you. I wish there were more of you still here, but I think I may have also had the pleasure of being in the division when it was at its largest, and maybe its largest ever. But that was a huge joy. Two themes from the time that I was here, one somewhat chronic, the other more acute. The first chronic one is exactly as Dahlia mentioned. COVID was still very much going when we got here, not in the acute market influencing moments of the crisis, but in two profound ways, I think, for everyone who was working in the division. The first being having to work remotely and trying to run a managing executive's office, as Ame and Chris and Anna did when no one was around, and yet people needed all the equipment and connectivity that they needed to get the job done. But the other, of course, being the amount of policy issues that were downstream of that. So when you saw the markets contracting and having major crises during March of 2020, there were a lot of rulemakings and policy issues that cascaded out of that a lot of the rulemakers spent a lot of years trying to work through on issues of liquidity, for instance. The acute example that was most telling for me when I first got here was within 2 months, Russia invaded Ukraine. And though, of course, everything Norm said is exactly right, we spent a lot of our time working on what the issues of savings and investments mean for people's distinct individual futures. It's unusual, it was unusual to me anyway, to consider that what we do here also a matter of sort of global geopolitics and maybe national security. So very soon after Russia invaded Ukraine, there were sanctions and then counter-sanctions. That meant the markets in Russia essentially stopped functioning, and there was a very unusual perverse outcome that if you wanted to understand or have a sense of what the value of Russian equities were, you needed to look in the only place in the world that you could find that out, which was an American ETF, which was a very unusual circumstance. But having to learn a lot of that very quickly was actually an extraordinary experience, because it meant working very quickly with the firefighters in our analytics office, understanding that what they do is extraordinarily useful in moments of crisis. I think about it all the time now when I think about markets dropping 10% and wondering if we have enough people to actually have the kinds of conversations to assess whether some people are actually exposed to a much greater concern than 10 or 15% down. So that was a very intense introduction to the skills and the excellence of the people in our accounting office, but also in our analytics office, but also then having to work very quickly with industry to get a lot of 22E relief, seeing industry get on a phone call with one registrant. I remember having 45 people on a WebEx call. It's a pretty good visual illustration of how concerned they are. But that was a really intensive, immersive experience to seeing exactly what the people in IM are capable of doing, which is extraordinary things under enormous time constraints. But as has been said by others up here, it really is, for me, what I will continue to remember is the quality of the people that I worked with. And just on that note, let me say thank you again, Natasha, for inviting us. And John Cavan, I know you're working very hard. The day will be over soon. But it's a delight to come back, and it's a delight to be part of this presentation.
Well, I'd also add to your tenure the impact of adding the Emerging Trends Conference, which has been a resounding success even through its evolution of its third year. And we get a lot of credit to you and all of your predecessors in that, we talk about what the event of the day is, what the market issue, what the regulatory concern is, but we're always, even in our smallest capacity of staff, always thinking forward, and that's what this conference is about. Before I kind of move on to maybe get your perspective collectively down the line, I thought I'd throw in a fun question, because I think my next question might take up some time and we have 18 minutes left. But one of the questions I wanted to ask, and I know that the staff here especially who are joining us in person and online, what is your favorite IM memory? I know we talk about the dedicated staff, but there must be something in particular that you've recalled during your tenure that just brings you fondness. And if you would share that, William, I can let you go first.
Sure. I'll cheat and I'll give two. I mean, the fondest post-job memory is the IM holiday party, which I remember being excited to come back to for the first time last December, and speaking with maybe Gurbir Grewal, maybe Hao Shangju, about how much I was looking forward to seeing them there, and them telling me in our divisions alumni are not welcomed back. So I treasure the fact that IM does that. The one very distinctive memory I have was giving a presentation in an open commission meeting in my office upstairs, but via WebEx, because they were all still remote. And after some statements had been made and the commissions were making statements and I was getting prepared to begin answering the questions and answer, my computer went through its perfectly timed forced reboot. And I remember sending a text message to the councils, in particular Elena Stojic. In fact, I'm not even sure I sent the text message. I think I stood up in my office and looked at her office, and she could tell that I wasn't meant to be standing. I was meant to be in front of my computer. So she literally ran to me, and then I think down the hall to Sarah Tensitoff's office, because she was in the call, to see if we could find a computer that could actually work to allow me to answer the questions that were coming in 90 seconds, 60 seconds. There's not a lot of great drama, a lot of high drama that occurs on the floors of the 8th floor here, but that was one. And as with pretty much everything else I experienced in my time, it was handled with such aplomb, with such calmness, deftness. If you're in a crisis, I think Sarah Tensitoff, Elena Stojic, and the staff of IM, those are the people you'd like next to you. I remember that one very distinctly.
Well, I learned when I took on this role that, yes, alumni are invited to the holiday party, and you were right, no other alumni are invited to any other party. And before I knew that, I thought I would have said the enforcement holiday was the best of the best. But they proved me wrong. So I'm excited also when I depart to be able to come back. So thank you for that. Dahlia.
So I'm going to say the holiday parties is an amazing tradition. We lost some parts of it, like the spiked eggnog, the non-alcoholic eggnog. Brian's eggnog was amazing, and no one got his recipe before he retired. And then Paul's turkey, the fried turkey was amazing. So, but the one thing I'm going to have to just, two things, complain. My first complaint is I joined the division in 2004. Part of the holiday party is the dessert competition. I have asked every single year to be a judge, and even when I was director, I was not allowed to be a judge. I am still holding out for that, but I don't know why I'm not allowed in the room.
Is this when I tell you that I judged last year's holiday party dessert?
See? It's dessert discrimination
Maybe
going
they just
on
think
here.
maybe they think you're too critical. I don't know.
I don't
One of the
know,
two.
but I've been asking every single year, and we're getting to 20-some years now. And then the other one, Natasha, actually, I think you might relate to this one, the Child Care Center, Mousegate.
Oh, yeah.
You remember that one?
I've never seen so many angry SEC parents.
Yes. So I was on the board of the center. There was apparently there were mice, and there were some parents that wanted to shut it down, and those of us who didn't want to shut it down. So they actually brought us in all into a main room in the child care center, where they were trying to present the yays and the nays and whatnot. And I was like, it's not a problem. And there was a scream because then a mouse came right out. So that was one of my all-time favorite. Yes, and the child care center was shut down despite my trying not to get it shut down.
I remember that fondly, actually, but I had forgotten it until you said that. But yes, one of the things about the SEC staff is they are very passionate about the mission of the agency, but they're even more passionate about the safety of their children. So, Dave?
On the holiday party theme, I don't know if it still exists, but there used to be a Santa costume.
Oh.
And
Santa Claus.
still, it still exists. All right, well, it's had a number of users over the years, including me once or twice, and as you know, I'm pretty tall and skinny, so, it like hardly covered my arms or my legs or whatever, and I certainly didn't have the pot belly, but it's a great tradition, right? Because Santa gives out the gifts to all the kids that are there, and even though I looked totally goofy in the Santa costume, the kids were very happy to get their gifts when I was Santa one year.
All right, I can't match the holiday party stories, but I'll go with two things. The first, the incredible intellectual challenge and the incredible rigor that people approach rulemaking, and I'm looking at some of the people out here like Jen McHugh and Judy Lee, John Hertzke, Brian Johnson, Dan Call, like talking policy, ALPA, like going over policy and trying to understand the provisions of a rule and the provisions of a release and how those might impact, right, the actual real world. And there are those conversations. I can remember some conversations with all of those people around rulemaking and around impacts of policy. And although what we all now do in private practice is certainly interesting and demanding, there's really only that time that you can be there and conversing with people of that much talent and that much sophistication about rulemaking. So I treasure those memories. Now, on the other side, the great part of government travel was all the crazy rules, as everyone knows, about this. You had to take this flight, the lowest bidder, you had to do this, that, and the other thing. So one day, the director of IM, me, and the deputy director, Mr. Grimm, were out in California. Unfortunately, there was some sort of entity out there that was in trouble. I can't even remember who it was. But so under the government travel rules, we were forced to rent the smallest rental car that I have ever been in. And literally, there is a photo evidence of this, of like the two of us packed into this micro compact car. Dave's actually out the window trying to stay. And of course, we're on the California freeways. I'm like, if we get in an accident in this, like, that's it, right? It's over. And so I have to say, I do not miss the government rules on travel and flights, and particularly small rental cars when I'm with Mr. Grimm.
I can confirm they've gotten no better.
I don't have any one memory, an event, but I really appreciated the folks in the division. I came to the SEC, I was 55, and I'd never worked at the SEC. I didn't know how it worked. You know, I kind of knew what it did. And, you know, the staff was just so helpful to me. They could have buried me in a minute, right, on any number of things. And I just had so many folks that really just helped me through. I knew stuff they didn't know, but God, they knew so much that I didn't know. And so that's my real memory. And I guess one event, when I was leaving as division director, you know, I basically said, listen, I'll pay for my retirement, you know, for the party. But I said, no, you don't do that. We charge for it. I said, not charge anybody. I'll pay for it. And all of a sudden, it was like loaves and fishes started showing up. You know, people in the division said, well, you know, we have some beer left over from the Christmas party. We'll bring that. I'll bring food. I'll bring food. And it was just, you know, how, you know, just great everybody was about, you know, on my way out treating me well, but actually how well everybody treated me when I was here. So I thank everyone. I'm looking at Jennifer McHugh there. Jennifer, thank you so much for what you did. And, you know, an example and many others, obviously, who were just so helpful to me, enabling me to survive, if you would.
I would note that I hope there are not films of some of the holiday parties from some of the earlier ones. They were less than tame, not during my tenure. I think back to the camaraderie of the division. I think the division, as long as I can remember, I worked with Joel in the old days, but it always felt much more like a family. We always got along, and we would have debates. But in the final analysis, we worked together, and if there was a crisis, it was just something to behold. It's not an event. It's not really a particular happening, but one thing that I will always remember, and I'm not sure what happens with it today, the IM division had an amazing library that was maintained by librarian Alice Latimer that was just astounding as to what it had. If you wanted to know about the Vanguard exemption, which was a major aspect of regulation of the mutual fund industry, she had it, all these written records. It was just, to me, I used to come in early in the morning showing how wonky it was, and I would read some of the history. It was great. And I don't know whether it's maintained, but what a resource it was.
My fondest recollection is not a specific event, but an impression throughout my entire time at the SEC of how much integrity the investment company industry has. It's not perfect, but considering how much money is involved, it's really remarkable how honest everyone is, and I think it can be summed up in a line that Kathy McGrath, who's no longer here, she was a division director, said that this industry's idea of a scandal is they go to the mutual funds conference and get free Dove bars.
Alan, do you have any?
I've got a few, I guess. Well, I have fond memories of the days when we had offices with partitions that didn't reach the ceiling, and the cigar smoke would come over. And sitting in, when we did have closed offices, sitting in the corner office with the senior people in the division, and listening to Saul Friedman, who ran the corporate regulation division and was a veteran of the Public Utility Holding Company Act regulatory structure. Great guy. But more specifically, when Lyndon Johnson was the president, he thought that he would use technology to the greatest extent, and he insisted on having direct telephone access to every commission chairman with a red phone. So Manny Cohen, who was our chairman, decided he would do the same thing with the division directors and the associate directors. And then one day, the assistant directors, and I was the assistant director at the time, one of the assistant directors, and I had a red phone, and I was so proud of it. And it never rang. It never rang until one day when the setting was perfect, absolutely perfect. It was like 7:30 at night. I was working, and the phone rang. And I picked it up, and it was Manny. And he said, "Who the blank is this?" I said, "Alan Mostoff." He said, "Oh, shit, I didn't want to talk to you." And he hung up. And then I got a Bill Casey thing. Didn't directly relate to me, but when he came to Washington, he bought a beautiful mansion directly across the street from the Japanese embassy. And when they heard about it, they were very upset because they wanted to acquire it themselves. And the real estate agent came to Casey and said, what can we do to accommodate them? And he said, "Tell them to remember Pearl Harbor." That was it. Yeah, he was a tough guy. So it was a good time. But you know, when I was the director, we had problems that accumulated over the years, but we had the benefit of having an industry that was growing, expanding, and we were trying to adjust to positive developments as opposed to major crises. And the last major crisis was the special study, which reminds me about the discussion that's been going on in academia and what have you about the possibility of another special study, and that would certainly address some of the thoughts that you had, Norm. I wonder what's happening with that, if anything. But it might be timely to do that with all of the complications that would involve. The special study was a wonderful contribution to the regulatory structure.
So we only have 2 minutes left. I know, shocking. I don't know that I did a great job of corralling this panel, but it has been a real pleasure. I wanted to give one person one final chance to say something, and I figured the only way that I could do that was whoever thinks that they wrote the longest rulemaking release by page number will get to have the final word. And so I leave it up to you. You guys want to think about how many pages, what release, and then you get the last word.
Private fund advisors,
Do you remember how many pages?
700.
Can anyone beat it?
You win.
You win.
Yeah.
Good for one. Although
I'm not sure
I
I would
wasn't
have
sure
put
you
my
want to take
hand
credit
up
for that.
for like the longest release, William, but you go for it.
Well, I actually am very proud of that one. It was ahead of its time. I think the entire industry is now looking to see whether or not retail investors should be protected for those kinds of investments. And as with many things the staff did, they worked their butts off on something extraordinarily important, even if it's insufficiently appreciated by the world.
Any thoughts on where you think what the next 85 years will look like? You got 1 minute.
Is that to me?
Yep, that's you.
I think it is going to look, or at least travel in the same direction it has across the entirety of this panel's time, which is an insatiable, ineluctable drive of almost everything else in the market to find its way into a fund. And one of the things that struck me the most about the time I was in the job was everything else the markets do is done or done better in funds. Even seeing registrants attempt to file single stock ETFs for exposure to Samsung or Saudi Aramco. But all of the items that you talked about, Natasha, in your opening remarks, and Commissioner Peirce talked about, the degree of innovation is, it seems, magnified and more dynamic inside funds than anywhere else. And I say that with particular relish to our colleagues who are directors of once relevant divisions like CorpFin and Trading and Markets. I think funds are eating the world, and I think they'll continue to, private and public.
Yeah, I think we've seen the division, but also the market evolve significantly over the last 85 years. I'm sure, Alan, you couldn't have even imagined thinking about what a crypto asset would have been and how to regulate.
Can you tell me now what it is? I still don't know. And I certainly hope that the directors of funds that do crypto will understand what those investments are. And the role of directors, I want to say, is going to be critical in the future.
By the way, Natasha, the longest release, actually, I'm getting a lot of, it's money market funds, so whichever director had, yeah, I think so.
See, as you said, I was trying to stay low on that one.
Yeah.
Thanks
Sorry,
whoever emailed
Norm.
that
Well, I
We
think
have to go back
we'll
and
close
find out
on
whose money market fund was
yeah.
longer.
I think we'll close on the note that you can always leave it to the staff to tell you what the true right answer is. Thank you so much. It's been a privilege, and I look forward to the next time.
Thank you.
Thank you.
I'd like to welcome you all to panel 2, Digital Assets and Tokenization. I'm actually not going to do an introduction, but I am going to throw the ball over to Scott Walker, our moderator. And thank you again to the panelists for participating. We look forward to the discussion. Thanks.
Oh, wait, mic's off. There we go. All right, can you guys hear me? Mic check. All right, thank you, John, for the introduction, and welcome everyone. Thank you for the attendance. My name is Scott Walker. I am the Chief Compliance Officer for Andreessen Horowitz, also known as A16Z. We are a venture capital firm that invests across a number of different advanced technology domains, including but not limited to Web3 technologies and crypto assets. And it is my honor today to moderate this panel with the subject matter experts that you see in front of you, and that represent a number of different segments across the market. So we have Nadine Jakar, the head of DTCC, Digital Assets, Amar Kushanad, the CEO of Copper, and Mike Muir, the head of Digital Assets for Franklin Templeton Digital Assets. And in a moment, I'm going to ask each of the panelists to give a little background about themselves, as well as give us a high-level overview of where they sit at the cross-section of financial services and blockchain technology. But before I do that, I thought I would try to level set a little bit, given we're going to be talking about tokenization and the trends thereunder. We'll get to tokenized products, collateral optimization, transfer agents, custody and settlement, et cetera. But what we're going to try to do is speak across kind of 3 different dimensions. So kind of the state of play, like where we are today, where things are quickly evolving to, and some kind of key challenges therein, and then eventually get to kind of what the North Star is. So like ask the panelists for their predictions, and I've got a couple of fun questions lined up. So
I'm going to stop talking, and Nadine, I'm going to pass over the mic.
Well, thank you, Scott, and thank you so much for the opportunity to be here today. As Scott said, I'm Nadine Shakar. I run the digital asset group at DTCC. I think most of you, usually when I ask who's heard of DTCC in any settings, nobody answers unless they work at DTCC. But as you know, we're the post-trade provider in the U.S. markets. In terms of background, I'm recently new to DTCC. I came across via an acquisition DTCC did about 2 years ago now. They bought a company called Securities, which I had the privilege of heading. And Securities is a harmonization integration fintech that also specializes in data and in tokenization services. Prior to that, I've had a long career at both custodian banks, both at the Bank of New York and State Street. So my history is one where I've definitely been dabbling in a lot of the infrastructure of the markets for a very long time, and now I've had the opportunity to marry it with the new technology and hopefully chart a path forward on how that all can come together. So thank you again for having me today.
That's great. Thanks.
Thanks, everybody, for having me. I'm Amar Kuchinad. I'm CEO of Copper Technologies. We are a custodian and collateral manager in the digital asset space. I am relatively new to crypto and the digital asset industry, having been a traditional finance person for most of my career, including a stint working here at the SEC in trading and markets as a senior policy advisor. Copper is, as I said, a custodian and collateral manager, but we're really focused on the trading aspect, so probably a layer above where DTCC sits in the tech stack. Ironically, we also bought a part of Securities that DTCC did not buy, and it forms the basis of our Abu Dhabi operations now, a digital asset broker-dealer that we have there. And I'm really looking forward to continuing this conversation here with this panel.
Good evening, or afternoon, I should say, everybody. I'm Mike Muir, and I have been with Franklin Templeton for about 19 years now, although I think I'd rather say my background is in software development. I spent most of my career before and during the early parts of Franklin as a software engineer. My own sort of initial foray into this whole thing we call cryptocurrencies and blockchains dates back quite a few years. I'm one of those people that ran a Bitcoin miner in their closet for a period of time. And my own personal horror story involves deciding not to continue to do that in 2016, I think it was, when it seemed like at the time Bitcoin was an interesting technological and academic experience, but maybe didn't go much further than that. Obviously, that was a pretty terrible prediction on my part, but always had an interest in this general space. I think just to reflect upon the course of the last 20 to 30 years, really 30 years of technology, particularly circling around the internet. One of the original problems is that value has never been able to be represented natively on the internet or on computing systems. I think we all have a sense of why that is. Along comes this invention called Bitcoin that establishes for the first time the idea of digital scarcity, that you can actually have data that represents something of value by itself, that doesn't just reflect some other thing in the real world, but is itself of value. I think that's really remarkable. I think that there's something to deeply contemplate about that for everything else that we treat as an asset, a thing of value in the world as well. We'll talk a lot more, I think, about these realities as we go forth, but thank you for having me. Appreciate it.
Mike, we're coming right out the gate, of course. We need to know, did you hold on to the Bitcoin that you mined?
Well, yeah, I did, the majority of it, but one little story you might appreciate if you're into Schadenfreude is we used to do these little trivia sessions in one of the development teams at the company. This is kind of a fun thing when you have a group of a dozen or so really sharp software engineers is you construct a trivia session where the goal is to try to stump everybody else in the room with some fact or some reality of software in the past, and that turned out to be a pretty challenging thing to do. You get enough people around that are steeped in this practice, it's quite hard to stump them. So that was the goal of the trivia session, and it would go week after week after week with no winner. So one day I decided I would put a little award on the line, and I offered up half a Bitcoin to the winner of a future trivia session. More months go by, nobody wins it, but somehow somebody did win this trivia session at one point, and I handed over half a Bitcoin. I think it might have been worth $300 or $400 at the time. Now, to mollify my horror, they went and sold it about a year or two later, thinking that they had made a killing. We're talking about very small fractions of current market value, of course. So, yeah.
Oh, that's great. Actually, Mike, why don't we stay with you? And let's hit tokenized products first.
Yeah.
So, obviously the landscape has changed rapidly in the recent the recent past. Could you walk us through some? Obviously Franklin Templeton has a number of products, but if you could spend some time talking about the tokenized products that you offer, and kind of, I think what would be really helpful to understand is the why. Like, is this a reduction of costs? Is it an operational efficiency, or are you just looking for like additional pools of liquidity?
Okay. Well, as I mentioned, I'd been dabbling around with cryptocurrencies myself, particularly Bitcoin, for quite a while. And what I noticed over the course of time is that there was a few other people in the office, particularly in our trading community and in our technology community, that had been doing the same. So we started to sort of just casually connect the dots and exchange ideas and think about this. And I remember in the 2018-2019 period, that became a little bit more serious. More people with more decision-making capacity being involved in thinking deeply about the potential for these things called blockchains to be a whole new record-keeping system for all things of value, but particularly financial services. So we concocted this idea to start a new department, really, within the company that we would simply call Franklin Templeton Digital Assets. And we wanted a sort of an initial project to explore this idea of using a blockchain as a new type of ledger. We all know that ledgers, or these databases as they are now that record ownership of things, are riddled throughout the financial services industry, riddled throughout the companies that play various roles throughout the financial services industry. There's many, many of them, and one fundamental issue with them is that many of them have to be in sync with one another, because different businesses that play different roles all are dealing with the same asset in different parts of the life cycle of an asset. So naturally, they need to be in sync. We can't have a total divergence between a distributing broker-dealer's record of ownership and the issuer, the issuing transfer agent, for that matter. So we decided, why don't we take a really bog-standard mutual fund, a money market fund, and try to represent the top book, as we think of it, the shareholder record, on a public blockchain, to replace the data set or the database that our transfer agent, our legacy transfer agent, had traditionally used, which is a relational database. And so just initially, the key thing to recognize here is we're not talking about the entire market structure of everything all the way from the shareholder down to the underlying assets. We're talking about something that we could carve off the top that is reasonably separable from everything else, and that's the shareholder record, the domain of the transfer agent. We approached the SEC, all of you folk here, a very large number of times through 2019 and 2020 and beyond to bring this about, and that we call Benji. This is the Franklin U.S. Government On-Chain Fund. It's also worth remembering that at this point in time, interest rates are effectively nothing. This was a perhaps experiment or maybe proof of concept gets thrown around. It's a real live product, but still we're seeking to validate the assumption and the thinking that these things called blockchains can be superior record-keeping systems to the kind of centralized databases that are so commonly used. Now, as William on the previous panel mentioned, we have a land war in Europe that comes along. We have other impacts to our global economy and some increase in inflation. And so central bank action kicks into gear and interest rates come off the floor. And all of a sudden, the thing that we have done in this experiment actually might have commercial value. So that's when we sort of breathe new life into well, what is the commercial value for this thing, and what features and functions can we bring to bear that have not been seen before in a money fund in the traditional sense, let alone any other investment product. That's what we've been doing for the last few years. We now have 3 variants of this money fund type construct in play in various jurisdictions globally. But particularly, I think we focus on the U.S. mutual fund Benji.
And can you give us some sense of how has it grown in terms of acceptance, as well as do you see at this point like financial advisors starting to kind of rotate client portfolios into the product? I mean, how much traction is it getting at kind of the retail level?
At the retail level, it's fairly muted. And by and large, we haven't focused largely on retail for the past, well, in the past. We have focused a lot on institutional. That's where a lot more demand has been, particularly businesses that have grown up around the crypto ecosystem that are looking for safe places to park capital. That has been a large part of our investor base so far. And I think there's something about that that's worth noting, and it goes something like this. These businesses that deal in digital assets, particularly cryptocurrencies, they have established for themselves all of the infrastructure and all the technologies, including what everyone here on the panel has done, a large amount of the portfolio of A16Z for that matter has done. They're very, very familiar with, and they're highly attuned with how to use public blockchains, how to query them and understand their positions, whether it's a cryptocurrency or otherwise. So when they see a product like what we have put forth here, where the record of ownership is in that same place that they've already built a lot of tooling and capability around, it's a natural fit. And I think we hear this from time to time from clients like this, that being able to see independently their ownership without having to necessarily rely upon a periodic statement that might come every quarter or every month, but in real time be able to see their position is something new. And it's not just somebody telling you as a second party, this is your position. It's coming directly from the system of record. There's something, I think, novel about that, and we do hear from our clients that this is a valuable characteristic.
Wow, that's fascinating. And I have to plead ignorance on this next question, but I'm interested to know, is Benji, are the assets on only one chain, or have you kind of solved for interoperability? And by the way, just to contextualize this for everybody, because I know I was told in advance of this panel that not everybody in attendance works in the blockchain space or deals with crypto with any degree of regularity. Think of blockchains as simply virtual computers because they are computers in function, but without physical embodiment. So they, for all intents and purposes, are a software layer kind of overlaying physical devices, and devices plural because these are distributed systems. So multiple users can be on any one chain working concurrently. But the challenge that Mike's about to talk about is that we're talking about different software layers. So if I'm a buyer of Benji, if for example, my share is on Ethereum and I'm trying to do something on a different chain like Solana, if there's no way to do that with that particular asset, I'm stuck. But I wouldn't necessarily even know that just looking through my wallet. So hence sorry, I wanted to give a little bit of background before that question.
I think for all intents and purposes, well, not all, but for most intents and purposes, you can think of blockchains as a new type of database. It's a new type of database to store information in a slightly different way than we're used to with relational databases in particular, or hierarchical databases that came before them. So technologically, that's sort of the use case here. It's the storage medium for records. And we can talk all day about why that's useful and different and all the benefits that come from it. That's probably not super important at this moment. One phrase we use at the shop here is digital nation states, because it's quite helpful to think about different blockchains, the way we kind of think about different domiciles or different jurisdictions that we might want to issue a type of product into. That's effectively, and don't get too hung up on the sort of political, legal boundaries of countries, but it's helpful to think about it in that way, because when we have a product like Benji, we want to make it available in a number of different realms. Or you can think of them like realms or environments that have distinct user bases and distinct clientele opportunities. So yes, we do issue Benji on a number of different blockchains. We have a suitability criteria that we developed, in fact, with much of your help as we went through this, that says here are the characteristics and features of public blockchains that we think are very important as a threshold for this type of record keeping for a registered security. So it's not any and all blockchains that are out there, of which there are quite a large number, but it's certain successful, large, and reliable networks that we have chosen. There's about 8 of those right now. And one of the things we support is the ability for you, the investor, to select which network is more suitable for you, for whatever reason, and to be able to move your holdings in Benji between them by way of interchain transfers.
I think I'm going to step in just for a second. As the most recent joiner on the panel into this space, I often think of this as something that we actually dealt with a lot in TradFi, which is if I had a Euroclear eligible security that we traded when I was trading EM, like the Reg S version of a bond, and we wanted to trade with the US counterparty and needed to convert it into the 144A, which usually settled in DTCC, then we would have to do some sort of transformation. And that's similar to what I think you're talking about, is these are different rails that we're using to record ownership and settle trades. And one of them might be DTCC, Ethereum, and one of them might be Euroclear, Solana, and one of them might be, I don't know, Avalanche, which is Clearstream. And so there needs to be a process that bridges across these, and many investors are connected to all three. Some investors might only be connected to one, and so you need to have some bridging process. But a lot of this, I think, as Mike said, not as a I have none of the technology chops that Mike has, but this is just another database in which we record ownership of assets. And so about 85 years ago, when when we were talking about the history of the SEC, we were recording ownership on pieces of paper that were stuck in a file cabinet or in a vault somewhere. And we've slowly evolved and changed the way that we record ownership. Then it was on probably bare metal on-prem in some office, then moved to a private data center cloud. And then, some might even hold their record on an AWS cloud. What we're talking about now is just changing again. Another variant of that is to have this distributed ledger, because there is some benefit in having a database that a bunch of parties share. And that's what I think we're looking for, is the efficiency in that.
Yeah, it might just dovetail on the back of that. Amar, you just highlighted, I think, a major characteristic that we think a lot about for blockchains, is that they represent not just a database for something like a transfer agent to use, but they are a shared database. They're something that many, many actors can all see the same information at the same time, in sync with one another. So this has pretty major ramifications now and into the future. I mean, firstly, you might think of the client base. I just mentioned an example where we have some clients that say to us, well, we really like the fact that we can see precisely, anytime we want, exactly what our holdings are. I don't have to wait for a statement to come along. There's something a little bit real-time about that. You might think of it as reporting or information availability. We'll touch on a little bit of this, I think, as we go forward. But then we can also think about the structures of our financial services, where we have many different types of businesses, many different registered entities that all play a role in the life cycle of an asset. And one of the classic problems that I think it's fair to say exists throughout the financial services industry, as I mentioned earlier, we have many of these businesses with effectively copies of the same records that need to be synchronized with each other quite frequently. Obviously, we kind of have a situation where they're diverging if they're speaking to the same thing, just in a different part of the life cycle. So now we have the possibility that they can all share a common substrate, a common data store, and be able to see and sync with each other the same information at the same time. So I can know the total issuance of, let's say, Benji, and its disposition across investors or any components that make up the entire workflow or life cycle of that mutual fund are all in sync with one another. I don't have to worry about reconciling the results between these different observers. It's done for me by the blockchain. That's one of the major reasons why we think these are superior record-keeping devices.
And maybe we move on a little bit. Amar, I'm curious, how are your trading clients utilizing tokenized products like what Mike just described?
Yeah, so, he described one of the use cases, which is for those that are maybe more blockchain native. It is a investment tool that they are more accustomed to using in their operations. Most of our clients are crypto native trading accounts, some increasingly more traditional finance players who are getting into the crypto space. The crypto asset class as a collective is $3.5 trillion of market value, and has become an asset class that people take speculative positions in. Miners need derivatives to hedge, and so there's a bunch of trading infrastructure that's come up around it, just like there is around other more traditional asset classes like equities, FX, interest rates. So our clients tend to be the ones who are trading on derivative trading venues, either trading futures, forwards, options, who then need to post collateral to each other so that there's some initial margin and safety and mitigating counterparty credit risk. And what they've found is that posting securities like Benji is a very efficient way for them to get their collateral posted because, one, they earn interest on that, which most of crypto is not interest-bearing assets. And two, you can actually move it relatively rapidly, so when you need to actually make a variation margin call, you don't have to wait T+1 to make sure that it actually settled. So many of our participants, whether they're OTC derivative dealers or the centralized exchanges that are trading crypto derivatives, have hourly or every 2-hour margin calls. And you would think that's going to be operationally excessive and really burdensome, but because of the power of the blockchain, you're not reconciling every time you move collateral that the collateral actually moved. So some of the advantages of blockchain is that you get this very frequent cadence in which you can move collateral, bringing the risk in the system down. And we're really excited about that. And we're seeing a lot more use cases in traditional asset classes for similar service.
And excuse the ignorance, but is that rapid kind of margin call, the collateral settlement, is that happening 24/7?
24/7, 365. Now, obviously that requires, there are still humans in the loop. So that does require us, we're a scale-up company. We're not by any means the same size as Franklin or DTCC, but we have operations around the world. We have people who are on call around the clock to service clients. But it is a 24/7, 365 market. I can't believe I'm going to say this publicly on something that's going out on the internet, but I am actually a bit of a crypto skeptic and joined Copper only because last summer when I started looking into what the company did and met some of the advisors and some of the exec team, realized that if this had existed over Lehman weekend, my life at Goldman would have been very different than it was in 2008 and 2009. I don't think we would have had $2 billion of open exposure when we walked in on Monday morning, because we would have had the ability. We had trading days over the weekend. The Fed organ,
the Sunday
right?
CDS unwind. Yeah.
Exactly.
Yeah.
And we would have been able to call for collateral. And Lehman posted the collateral they were supposed to post when we called them Friday morning. And I think if we called them Saturday morning, they still would have posted the collateral we asked them to post. It was only until 2 a.m. on Monday morning that they actually filed for bankruptcy. And so, I think that this kind of technology, if implemented correctly and with thought to existing processes, could really change the way that we view risk and capital and operational issues.
No, I agree. And a couple of weeks ago, we did set out to prove that leveraging blockchain as well. So leveraging blockchain is you get everything Amar and Mike talked about, but when you add tokenization to it, which is the ability of taking these records and trade them in a digital way on these blockchain, you add a certain level of programmability into the process. And so we did something a couple of weeks ago called the Great Collateral Experiment, and we actually did replicate, without calling Lehman out, but we did replicate a default situation. We did replicate the ability of, if you're a trader sitting in your seat in Tokyo and needed access to move U.S. securities while the U.S. markets were closed. So back to the points that both Amar and Mike are doing, you can now manage risk pretty much 24/7 in a way that is programmable, in a way that's utterly transparent. And what you're seeing right now is really the beginning of the art of the possible. And each one of us at different layers of the ecosystem is really trying to push and put together an infrastructure that is scalable and resilient to allow us to really benefit from all the goodness this technology provides. So it is real, it is here, and what we are seeing are the institutional investors right now, something that really grew up from the retail side of the market. You're seeing large-scale institutional adoption right now, which is pretty exciting.
Yeah, last year we moved over $2 trillion worth of collateral between parties who trade derivatives mostly on the trading venues and those trading venues. It is remarkable. Yep. Where this industry has come to.
Yeah, so I guess put differently, the collateral optimization process, it's already working its way into workflows, clearly. And
it's part and parcel of the crypto native world, and I think it's increasingly moving, as Nadine was saying, moving into more traditional scopes, right? I think again, I should not say this, we have a lot of crypto native clients, but I think crypto has been a great sandbox in which we're demonstrating the utility of blockchain and how well it can work at scale. And I think what we're seeing now is that adoption.
Rest assured, there are many other applications beyond finance for this technology, but we're limited scope in this conversation. Anyway, Nadine, I wanted to say with the Great Collateral Experiment, were there some learnings from that process? And one of the things I'm particularly interested in is like the implications of the 24/7 market for tokenized assets, and like contrasting that with the kind of fixed hours of traditional finance.
I mean, we've got a long way to go before all this is like a scalable reality, but what we have been seeing is, and especially some of the lessons learned from the Great Collateral, I'll tell you, the first thing to me, it was overwhelming, the response we got from our participants. When we embarked on that process, we weren't sure how it was going to be received. So the ability right now to create these global liquidity pools to seamlessly and efficiently reduce friction from the system, reduce operational risk, and also increase mobility of collateral, as well as enhance capital efficiency, has been proven we've got numbers, we got facts behind them. And right now, where we're at is really trying to sort through the legal components of that. How do we make sure all these tokens get accepted in the various jurisdictions that we traded and demonstrated in that experiment? I think you also asked on the risk side, the risks are pretty much the same, but now you've added a lot of cyber risk or technology risk to this that we're all used to managing, but now that becomes a more heightened way of looking at this in managing it. So like next steps right now is working really hard with our legal teams, our external legal advisors, and most importantly, the community, the participants that really own and govern DTCC to like take this to the next step. But we're very encouraged. We've gotten interest from CCP worldwide, actually, to become part of this collateral infrastructure. And that's what we've tried to do, right? A couple of years ago, there was a collateral management utility that emerged, which was, I think, a partnership between DTCC and Euroclear. I used to be at the Bank of New York at the time. And that was short-lived for a lot of different reasons. We've learned from those from those experiments, and what we've tried to do right now is really try to create a minimum viable common collateral infrastructure where the likes of Copper or Euroclear or Clearstream or Franklin Templeton, whomever, is interested in exchanging collateral in a tokenized manner in a way that gives you flexibility both in traditional sense. So for the traditional securities, we also demonstrated that you can take on crypto. We did a repo against crypto. So I think it was Bitcoin. So we were able to show how you can marry the old and the new. And I was chatting with Samara earlier. The press this morning is full of the news where now JP Morgan is taking a BlackRock crypto ETF and using it as collateral, so or lending against it. But it's just, again, they're baby steps, but it's every single step is heading in the right direction as far as acceptance by the institutional money, and we are very confident that that's going to be the next stage of where we head with all this. So we're very excited about the collateral experiment. How do you take it into production? How do you create these global liquidity pools that are accessible to all?
Oh, that's terrific. I'm going to ask one more kind of current operating question, and then I'm looking at the time, so then I'm going to go into my lightning round of predictions questions. So, Nadine, transfer agents. Obviously, there are a variety of different operating models that are emerging, and given what Mike has kind of hit on a couple of times, what is the future for transfer agents given this technology? Obviously, this is limited to kind of tokenized assets, but I'm curious to hear your perspective.
I think it's for everybody, whether it's their TAs, their regular custodians. I think they're all at a inflection point right now as far as, do you modernize and embrace? And I think Mike and his team, and Mike, you may want to remind me of the numbers, but you guys have proven that you can take transfer agency and really run it at super efficient rates. The savings were staggering. I'm sorry, I don't remember the numbers, but Mike is here. He can share those. I mean, you've gone down to sort of pennies on a transaction or dollars.
There's a lot that goes into it, but fundamentally, one of the things that happens here is you offload a very large amount of your data record keeping requirements outside of a centralized database environment that you have to completely lift up yourself, you have to completely operate yourself. You're effectively subsidizing that cost over to, in our case, these public networks. The public networks themselves are run and operated by a very, very large number of actors of all sorts globally. That's one of the things that gives the security characteristic of these blockchains. They're hyper-distributed networks, data networks. But one of the other things it does is you only have to spend the native token, which we commonly call the cryptocurrency, in order to use that functionality of that given network. There are wild differences in terms of the cost of using different networks, so that's a factor in here. But on the one end of the spectrum, there are some very, very cheap public blockchains to use that do not cost much at all to record transactional data. So just reflecting upon the fact that if you think about the total data corpus of something like a transfer agent, the vast, vast majority of that data is transactional and is quite suitable to place on these things called blockchains. That is sort of fundamentally where a lot of direct cost reduction on a unit basis comes from. But we can think a little bit further ahead as well. And I had mentioned this idea that we have this common data substrate, this common database effectively for many actors in the life cycle of an asset to partake in. There is the absolutely real possibility here to completely eliminate functions that we currently do to reconcile records and make sure that information ticks and ties that won't be necessary anymore. Think particularly of a third-party distributor that it has their own client base and is making available an investment product to that client base. Their records effectively, net, have to be in sync with the issuing transfer agent. That problem basically goes away when the issuance of that security is on a set of public blockchains, and both of those registered entities are using that same data substrate to coordinate an understanding of what exists, the issuance, and its disposition.
But
That's a good example of what comes in the future.
fairly decrease in cost, which is the point of the point you're trying to make. So to answer your question directly, I think it's twofold. They'll have to embrace the technology, and I think you'll see, I believe we'll see a consolidation. We'll also see them becoming, now today they're considered a good control location, but I think they'll play a more active role in distribution. So when you've asked a question earlier, how many chains you're on, most fund families are averaging 8 or 9 chains where they're distributing their products. So I think we're gonna also see a massive change in distribution models with these. I'm not sure, I don't predict they're gonna go away. I think there'll be a lot fewer of them doing different functions.
No, that's interesting.
That would be our estimates at this point.
Interesting. And actually, just now taking the thread on the distribution concept, I'm curious about the concept of inverting the like financial advisory client relationship or investment management client relationship. Do you guys foresee a future where investment managers are pushing out products that are customized or bespoke for the individual clients into their world?
Oh, God, yes. I think the era of mass customization is here. We do it today, right, like as an industry, but it's fairly expensive when you look at the data, you look at the indexing and the work that does it. I mean, we are experimenting with certain players in the marketplace where you can take a whole index fund and totally self-manage it. So think about this, if you could put your own risk profile in there, your constraints, your compliance, it will come a day where you could do it at scale for, pennies on the dollar.
Yeah, interesting.
We're not there yet, but it's in flight.
Amar, Mike, do you guys have thoughts on that one?
Yeah, if we're thinking a little bit through the looking glass at the future here, I think you can look at the features, functions, and behaviors in the general cryptocurrency landscape as a window to the future of what's possible with assets, with things of value. I mean, what you have going on there is the movement of actual things of value. There's value at risk in all the transactional activity you see with cryptocurrencies, but it's been expressed in this 24/7, always-on, real-time environment where everything is programmatically interactable. That feels like a glimpse of what can be possible here, and we look at the capabilities and the features that come along for the ride here in the cryptocurrency space as the exemplar of what should be therefore possible for anything else of value. In our particular case here, we're looking at units of a mutual fund. So let's just take one simple example, transferability. We have the ability now, and we have enabled this for our investors, to transfer any amount of their holdings in Benji to any other investor in real time, 24/7, with immediate effect. That hasn't really been a thing before in the investing landscape, in the securities landscape, and now it is. And that's a feature and capability that's informed by the cryptocurrency space, informed by the capabilities of cryptocurrencies and networks like Bitcoin and Ethereum. So I think we can look to that as an exemplar and use your imagination thereafter to think about how you might reconstruct and reimagine feature sets made available to investors for investment products, for security products, across the entire landscape of our economy.
That's great. Amar, all right, we're running very low on time. I have an AI question or a legacy tech stack question. Which one do you want?
Oh my goodness. I think legacy tech. I take legacy tech stack for 500.
All right. Here we go. What challenges persist in the legacy tech stack at most financial institutions that are posing an internal barrier to adopting some of the new technologies that are available?
That's a good question.
That's a great question. And actually, I was on a panel recently where some of the more incumbent players were talking about that. So I can actually answer that despite the fact that we don't have as much of that legacy tech stack at Copper. I think the legacy tech stack, the interoperability of some of the legacy applications that are in the space make it hard to connect what now can happen in blockchain to those legacy applications. Because blockchain's not replacing all of the reporting tools that people already have, all the accounting software, all the, right? Like you could try to rebuild that whole ecosystem relying on this new type of database instead of the traditional databases. And so what I think is the biggest hurdle is figuring out, okay, where are all the data dependencies and connecting a transformer almost, if you will, of let's get the data from the blockchain and then feed it to all these applications that require it. I think that's probably the biggest hurdle in the legacy tech stack, but it's no different than the hurdles that come right now when a bank is trying to upgrade what kind of CDs can they offer, right? Because there's some legacy tech stack that says that they have to mature on the 15th of a month, and they can't issue one that matures on the 21st of a month, right? For example, I think that there was just an article in the Journal about how this is going to bring AI into this for a second.
That's fair, but what we're talking about here is a distinctly different and faster moving tech, right? Than like if somebody just can't, like if a bank can't offer a new CD, that's not potential significant impairment of their enterprise, right? Which this may be a threat.
Definitely, which is why I think there's more of a focus on it than can I issue a CD that has a 21,
That's fair,
right?
yeah.
And I think that, so there's a lot more, how do I integrate blockchain into my existing organization? How do I get all the flows to work? I actually think probably the bigger hurdle is workflows and people and processes rather than tech. Tech is solvable. Given enough money and enough time, you can solve any tech problem, right? I mean, like I was just going to say that to bring AI into this so I can answer both questions.
Here we go.
Morgan Stanley just announced, right, that they had created their own AI that goes through and reads old COBOL and Fortran code and turns it into plain English so that new functions in Python and in Rust and in new modern programming languages can be written by current developers. So I think, that can be done. I think the bigger problem is like we were talking about, how do you get 24/7, 365? Who's setting up a process that does that? Who's setting up the process that makes sure that a database that is truly public has the cybersecurity controls that we all expect and that the SEC mandates from all of us who are regulated by the SEC? They're as a trader, as a former trader, how do I decide between good public data and bad public data? Like as a trader, I would never want anybody to know what my positions are at all the time, in real time.
Yeah.
But, in the blockchain, you can. Once you have attribution of a wallet, you can actually tell what somebody's doing. So I think these kind of questions, which are more process and workflow questions, are probably more of an impediment than the technology.
Excellent, excellent. Well, and nicely done on getting, wasn't exactly going to be the AI question I was going to ask. I'll get the agentic AI question in later, but nicely timed and nicely responded to. So guys, with that, we are at time. So I want to thank the panelists, guys. This was a fascinating conversation. And of course, a thank you to our hosts. And that's it.
Thank you.